SEGRO's board unanimously rejected Prologis' $12.6 billion all-share takeover proposal on 23 June 2026, calling it opportunistically timed and a bid that falls a long way short of the company's value. The shares were trading at 742 pence the day before the announcement, 40% below their late 2021 peak. On the day the rejection went public, SEGRO stock surged 15.6% to 864 pence, making it the top performer in the FTSE 100. That surge is the first complication. If the board's rejection was right and 925 pence represents too low a price, shareholders endorsed the decision by pricing the stock 16% above where it had been the prior day. Yet they settled at 864 pence, still below the 925 pence offer. The market said the offer was directionally fair, but numerically insufficient, not that the board was wrong to reject. The second complication is the 4-year track record. Prologis' offer document noted that SEGRO has traded at an average discount of 19% and 17% to its EPRA net tangible asset value over the last 2 and 3 years, respectively. The company's EPRA NTA per share stood at 925 pence as at December 2025, precisely the price Prologis offered. SEGRO's board is rejecting a bid at book value while the stock has persistently traded below book. SEGRO's own explanation for that discount is geopolitical. Major international events adversely impacted trading valuations across the UK and European real estate sectors relative to US REIT sector. That framing is factually accurate. UK and European REITs have lagged US peers in the current environment, but it is also the same environment Prologis called opportunistically timed. Both descriptions are simultaneously true. The discount is real, the timing is opportunistic, and the board's insistence that it is a transient dislocation rather than a warranted handicap is the crux of the dispute. Prologis' offer is all share. SEGRO shareholders receive 0.084 new Prologis shares for each SEGRO share. At the June 23rd closing price of $145.30 and a GBP USD rate of 1.32, that ratio implied 925 pence per SEGRO share. But the implied price is not fixed at 925 pence. It moves every day with Prologis' own share price and the exchange rate. This is the mechanism the headline number obscures. BMO Capital adjusted its Prologis price target downward on 29 June, reducing it to $158 from $162, explicitly citing concerns about merger dilution from a potential SEGRO combination. If Prologis' share falls further toward 145 or below, whether from its own fundamentals or from the market's view that it is overpaying, the exchange ratio of 0.084 delivers fewer pence per SEGRO share. A 5% decline in the Prologis price alone would reduce the implied SEGRO value by roughly 46 pence, from 925p to approximately 879p. This creates opposing pressures that today's poll documents directly. Prologis' public statement argues that SEGRO shareholders who accept the deal gain participation in a $140.9 billion logistics REIT with data center upside, outperformance track record, and 10 gigawatts of power pipeline. The relevant metric for them is the long-term quality of the Prologis share they receive, not the implied sterling price on announcement day. SEGRO's board argues the opposite, that accepting Prologis shares surrenders the upcoming inflection in SEGRO's own data center pipeline and occupational markets just as momentum is building, and that UK and European property valuations will eventually close the US gap through rate normalization. Both arguments require a buried assumption the other side treats as contestable. Prologis' case requires that its share price does not materially dilute before or after the deal closes. SEGRO's case requires that the current BOE REIT environment and UK political uncertainty, with a leadership transition underway and Burnham's economic agenda not yet formed, reverse before SEGRO's structural discount to NAV does. Neither assumption is currently evidenced in the pool. Invesco's Form 8.3 disclosures filed June 26 showed the fund simultaneously holding 2.8 million SEGRO shares long and 722,000 shares short, position hedging that reflects precisely this unresolved ambiguity about which direction the combination resolves.
The day SEGRO's rejection went public,
UK logistics property staged a coordinated repricing that clarifies the transmission path. Tritax Big Box rose 5.6% to 160.28 pence. British Land gained 4%, Land Securities rose 3.7%, and the FTSE 350 Real Estate Investment Trusts Index jumped 6%, all without being the target of any bid. The sector repriced because the Prologis approach revealed a floor. If the world's largest logistics REIT, with a $141 billion market cap, values European logistics property at a 24 to 31% premium to current UK prices, the sector-wide discount to intrinsic value is not a structural permanent feature. It is an exploitable gap. That sector read carries a reversal card that most commentators missed. Quilter Cheviot's Ollie Creasy noted that the entire UK REIT sector could be back in the shop window for larger foreign acquirers, a positive framing. But the flip side, which AJ Bell's Dan Coatsworth flagged, is that an all-share bid at this size raises a specific question for SEGRO shareholders. Would they rather hold a 10.5% stake in Prologis, a US dollar-denominated global logistics company with significant data center ambitions in North America, than hold SEGRO directly? The answer depends on what investors believe about UK real estate's next 2 years, not just Prologis' track record. If Prologis walks away by July 22nd, the sector faces a specific unwind risk. The plus 15.6% SEGRO jump was partly driven by strategic optionality pricing, the market paying up for the possibility of a higher bid or a forced standalone re-rating. A Prologis withdrawal would remove that optionality premium, and Tritax, British Land, and Land Securities would likely reprice alongside SEGRO. The June 24 PMI reading that accompanied the bid news, UK Composite PMI at 49.4, a 14-month low and second consecutive contraction, is the fundamental backdrop a Prologis exit leaves SEGRO navigating alone. Capital that rotated into the UK REIT complex on takeover sentiment has no structural anchor if the bid dissolves. Under UK takeover code rules, Prologis must, by 5 p.m. BST on 22 July 2026, either announce a firm intention to make an offer or confirm it does not intend to proceed, the so-called put up or shut up deadline. That date is the single variable that discriminates every branch of this investment decision. Prologis' current constraint is its own share price. The BMO dilution concern cut on June 30 signals that Prologis' own institutional holders are watching whether the exchange ratio, if it closes, leaves the combined entity's earnings per share diluted enough to matter. Prologis carried net debt to enterprise value of 22% against SEGRO's 37%. Absorbing SEGRO's balance sheet lever raises the combined group's debt load, and analysts are beginning to price that in before any firm offer is announced. The counter-evidence against the bull case is available in the pool and must be stated. SEGRO shares were already recovering before the bid. The FTSE 100 had staged several sessions of property-led gains tied to UK rate expectations, and the bid's 24.6% premium may reflect the moment's cyclical trough rather than a permanent undervaluation. If BOE rate expectations shift toward cuts before July 22, SEGRO's standalone price may close the gap with the implied bid value without Prologis needing to act. That caveat does not dissolve the thesis, but it defines the two-condition discriminator. The move becomes an entry setup if Prologis returns before July 22 with either a higher bid or a cash element that de-risks the exchange rate exposure. Either action would confirm that the strategic rationale is firm, not merely opportunistic. The move becomes a trap if Prologis walks away by July 22, the Invesco arbitrage positions unwind, and SEGRO reprices toward the 800 to 810 pence range that preceded the bid speculation. For a holder watching the board's July 22 response, the relevant indicator is not SEGRO's standalone NAV. It is whether Prologis has engaged its investment bank advisors with a revised mandate before the deadline. The first sign of that engagement is a takeover panel extension request or a Prologis market statement on revised terms. That signal, not SEGRO's own earnings, is what the board's "we are confident in standalone value" ultimately trades against. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.